This is a work on FOREX. It is compiled by Atogbe Ezogie Lucky. You can contact Atogbe Ezogie for anything concerning FOREX 375-97085. FOREX training for beginners. We're going to start with the course outline. We're going to begin basics. Under FOREX base, we're going to treat the following topic: what is FOREX? Why trade FOREX? You trade FOREX? How do you trade FOREX? After which we're going to move to the kindergarten school, and under which are 3 types of analysis, types of charts. After which we're going to move to the elementary school. Under the elementary school, we're going to treat 5 basic support and resistance levels, Japanese candlesticks, Fibonacci, moving averages, common chart indicators. After we go to the middle, under that we're going to pick which are 1. Oscillators and momentum indicators, 2. Important chart patterns, 3. Pivot points. After which we're going to move to the summer school, and under the summer school we're going to treat the Elliott wave theory and the harmonic price patterns. And later we're going to move to the high school, and under this market environment, 3. Trading breakout and fake outs, 4. Fundamental analysis, 5. Currency crosses, frame analysis. After which we're going to move to the undergraduates. And in the undergraduate year, we're going to treat market sentiment, trading the news, and carry trade. I'm going to treat the US dollar index, intermarket correlations, using equities to trade FX, and country profile. In the junior year, we're going to treat type of trader, create your own trading plan, keeping a trading journal. And in the senior year, we're going to treat risk management, and secondly, the number 1 cause of death of forex traders, under which we're going to treat subtopics like position sizing, setting stop losses, scaling in and out, currency correlations. Last but not the least, which is the graduation. Under graduation, we're going to treat Broker 101, forex trading scams, and graduation speech. Let us now begin from the very beginning. What is FOREX? FOREX is the exchange of one currency for another. For example, you buy yen and sell dollar, or sell dollar, buy naira. It is also known as foreign exchange market, or FX. It is the largest market in the world, with 4 trillion trade volume daily. So what is traded? The answer is money and nothing else. The price of a currency, say yen, is a direct reflection of what market thinks about the current and future health of their economy. So when you buy yen, for example, you are basically buying a share in the Japanese economy. Currency are traded in pairs. For example, we have the USD/EUR, USD/Great British pounds, the USD/Japanese yen, etc. For example, the USD means UXA currency, also called the greenback or the box. In summary, money is what is traded. Currency are traded in pairs. They are represented in 3 letters, e.g. UXD, GBP. They are traded through a broker or a dealer. It has no physical location where it is traded. It is considered an over-the-counter, that is OTC, or interbank markets, because it is run electronically with network of banks worldwide, 24-hour period anywhere. USD or US currency is the most traded currency, and it constitutes 62% of world foreign reserve. So the US is king, and it is the world's largest economy. 90% of trade volume is based on speculation, and this is what gives liquidity or volume to the market. So let us now look at the different ways to trade Forex. Forex can be traded in 4 different ways. They are spot, futures, options, and exchange traded form, that is ETFs. So the next subtopic is why trade Forex. In other words, what are the advantages in trading Forex? Number 1, no commission, government fee, exchange fee, brokerage fee except spread. Number 2, no middlemen. You trade directly with the market. Number 3, no fixed lot size or contract sizes. It is determined by you. Number 4, low transaction cost, with as low as 0.1% or even as low as 0.07%. It is traded 24 hours, anytime you are free. And number 6, no one can corner the market because it is so large. Number 7, you have the advantage of trading it with leverage. Number 8, there is high liquidity, and you can make use of stop loss, take profit, trailing stop, and other advantages. And lastly, there are free stuff everywhere. We have a lot of brokers, demo accounts can be opened, news as well as charting services are all available. The next subtopic is who trade Forex. Unlike the stock market that is traded via a centralized system, e.g. the New York Stock Exchange, the Forex market is decentralized and is traded by the following. 1, the biggest is the interbank market. The interbank market consists of largest banks of the world and small banks. They participate in the Forex market through electronic brokering services, EBS, or Reuters dealing 3000 spot matching. Reuters dealing 3000 spot matching. The second group of people who trade Forex is the hedge funds, corporations, retail market makers, and retail ECNs. They do their transactions via commercial banks. The least set of traders are the retail traders like us, and we do our transactions via internet, electronic trading, and retail brokers. Now, let us look at the market players. Number 1, the super banks, e.g. Citigroup, Barclays Capital, Deutsche Banks. The large commercial companies, e.g. Ample. For example, Ample may buy yen to get Japanese electronics. Number 3, government and central banks, e.g. the ECB, the BOE, the FRO, and they do this via interest rate adjustment to control inflation. This can create massive buy or sell to alter exchange rates. And lastly, the speculators. They comprise 90% of all trading volumes. This is where we currently belong. The history of Forex. The Bretton Woods Agreement after World War II. After World War II, the world was experiencing chaos. Major Western governments felt the need to create a system to stabilize global economy against gold. And this is how the Bretton Woods Agreement was formed. Later, economy of the world starts to grow and change at different speeds, and the rules of the game became obsolete and limiting. And in 1971, the Bretton Woods Agreement was abolished and replaced by a free floating exchange rate determined by supply and demand, with US taking the pilot seat. Later on, as a result of advance in science, communication and technology in the 1990s, created platforms for banks to stream live quotes to their clients to execute trade themselves. Meanwhile, some smart guys introduced internet-based trading platforms for individual traders, known as retail forex brokers, and make it very affordable. The retail forex brokers are divided into the market makers, who make or set bid and ask prices themselves, and the electronic communication network (ECN), who charges less commission. The next subtopic is when to trade forex. Forex operates 24 hours. Market hour is broken into 4 major sessions. We have the London session, which operates between 8 a.m. to 5 p.m. Nigerian time. We have the New York session, which operates between 1 p.m. to 10 p.m. We have the Tokyo session, which operates between 12 p.m. to 9 a.m. We have the Sydney session, which runs between 11 p.m. to 8 a.m. Nigerian time. Transaction or liquidity is busiest or most busy when sessions overlap. For example, the London and the New York session overlap. The European and the London session normally provides the most movement. 30% of all FX transactions take place during this time. The EUD, that is the Australian dollar, the JPY, and the New Zealand dollar pairs are most liquid during the Tokyo or Asian session. Then characteristics of the London session. The London session is the busiest. It has lower pip spread. Most trend begins here. Major pairs are most liquid. Volatility tends to die down at the middle as traders go off to eat lunch. Trade sometimes reverses at the end of session, as European traders may decide to lock in profit. And the characteristics of the US session. High liquidity when it overlaps London session. 85% of all trade involves USD, so US big news highly influence markets. Little movement as London closes. As London closes shop Friday afternoon, chances of reversal are high as US traders close position ahead of weekend to limit exposure to any weekend news. Best time to trade forex. Best time to trade forex is the middle of the week, that is Tuesday, Wednesday, Thursday. Fridays are usually busy half day. The busiest time are the best time to trade because it gives higher chance of success. And in this case, the London session. When two sessions are overlapping, volatility is high. It is usually the period for major news events and spark some directional movement. Next subtopic is how do you trade forex? Currency in forex are traded in pairs. For example, you have the EUR/USD, the GBP/USD. The first listed currency to the left is called the base currency, and the other counter or quote currency. You buy or long the pair if you believe the base currency will gain value relative to the quote currency. You sell or short the pair if you are convinced the quote currency will appreciate. If, for example, the GGP stroke the USD, and the GDP is the base currency and the USD is the counter currency, and the current price is 1.5125, it means you have to pay 1.5125 US dollars to buy 1 Great British pounds. That is if you are buying. Also, when selling, it means you receive 1.5125 USD when you sell 1 Great British pounds. In other words, if you buy, say for example, Euro stroke USD, it means you are simultaneously selling the quote currency. The bid stroke the ask. The ask is the price the broker will sell to trader. It is also called the offer price. The difference between bid and the ask is called the spread. Pipetics. Pip is the unit of measurement to express the change in value between two currencies. E.g., if Euro USD moves from 1.2250 to 1.2251, it means we have had 1 pip movement. How to calculate pip? 4 decimal places are used for pairs without yen, while 2 decimal places are used for pairs with yen. Some brokers use more than these 4 and 2 quotes. In other words, some brokers use 5 and 3 fractional pip system or pipettes. Each currency has its value and is calculated. For example, say USD stroke CHF, and if the value, for example, of this particular pair is 1.5250, we can calculate pips by say 0.0001, which is the decimal place of the currency, divided by the exchange rate, which is equal to what? The pip value. This is how we get the pip value. In other words, for example, if we have 0.0001 divided by 1.5250 will give us 0.0000655. That automatically becomes the pip value of that currency pair. Where the USD is not quoted first, and we want to get the US dollar value, we add one more step. Hence, if for example Euro USD is selling at the price of 1.2200, we calculate the pip value of that currency by saying 0.0001 divided by 1.2200, which is equals to 0.00008196 euro. The next stage is for us to multiply this figure with the exchange rate of the currency, and therefore we now say 0.00008196 times 1.2200. This now gives us 0.00009999, and we can round it up to 0.001. But don't worry, your broker often gets this done for you. So let us now look at lots, leverage, profit and loss. In the past, spot forex is traded in specific amount called lots, and we basically have 4 types of lots. We have the standard lot, which is 100,000, the mini lot 10,000, the micro lot 1,000, and the nano lot 100. If, for example, a particular pair, say USD to JPY, is selling at an exchange rate, or has an exchange rate of 119.80, we can calculate the P value in terms of the lot size by saying 0.01. Remember that JPY pairs have what? 2 decimal places. So 0.01 divided by what? 119.80, which is the exchange rate, multiply by the standard lot of 100,000, which gives us, or is equal to, $8.34 per pip. If the USD is not the base currency, it is calculated as thus. If, for example, Euro USD has an exchange rate of 1.1930, we therefore calculate 0.0001 divided by 1.1930 times 100,000, which is the standard lot. This now gives us 8.38. We therefore multiply 8.38 with the exchange rate of 1.1930. This now gives us $9.99734, and we can round it up to $10 per pip. The same expression goes if we are trading in mini lots, micro lots, as well as nano lots. So if we want to calculate profit and loss in this sense, say standard lots, say using a standard lot size of 100,000 units, and the price of the currency, for example, is 1.4530, and the price moves to 1.4550, it means we have gained 20 pips. What we do in this case is we now say 0.0001 divided by 1.4550 multiplied by 100,000. This gives us $6.87 per pip multiplied by 20 pips. This now gives us $137.40. That is how to calculate pips. So let us take a brief look at these following words. Cross currency. Cross currencies is any pair without the US dollar, e.g. Euro, Great British Pounds. Margin. Margin is a security deposit. It is money deposited with broker when you open a new account. Leverage. Leverage is the ability to control large dollar amounts with small capital, e.g. 2 to 1, 500 to 1, 200 to 1, 100 to 1. So let us now look at types of order. We have the market order. This means entering the market at the current price. We have the limit or penny order. This means entering the market at price other than the market price. We have the stop entry order. This means we buy above market price or sell below the market price. And we have the stop loss order. This is used to prevent additional losses. We also have the trailing stop. This is stop loss that moves as price moves. At this point, we advise to open a demo account and demo. And you are advised to demo trade until you develop a solid, profitable system before you think of real money. You must be smart and patient. You must consistently be trading profitably on a demo account before thinking of placing real money. You must wait for at least 2 months of consistent profit, or just donate the money to charity instead of FOREX. Start by concentrating on one major currency pair. The truth. The truth is that all FOREX traders lose money on trade. 90% lose money due to lack of planning, training, discipline, poor money management rules. FOREX is not for the unemployed. You should have at least $10,000 of trading capital in a mini account that you can afford to lose. FOREX is one of the most difficult but financially rewarding endeavors known to man. But if you do not have the discipline to stick to a diet or go to the gym 3 times a week, don't think of FOREX. That is that about FOREX basis. Now let us move on to the kindergarten stage. 3 types of analysis. There are 3 ways to analyze and develop ideas to trade markets. 1. Technical analysis. 2. Fundamental analysis. 3. Sentiment. The question to be asked at this point is that, which is better? It is like standing on a 3-leg stool. If one leg is weak, the stool will break under your weight and it will fall flat. So both 3 are very important. All the 3 are very important. Let us take a brief look at each one of them. Technical analysis. Technical analysis is a framework or chart in which traders study price movement. Traders look at historical price movement or past price movement and determine the present or current, as well as the potential of future price movement. History tends to repeat itself. Key support and resistance, as well as patterns and trends in the past, play a role in the present. Technical analysis is very subjective. That we all see the same chart does not mean we come up with the same idea. Fundamental analysis. Fundamental analysis is analyzing a currency on the strength or weakness of that country's economy, social and political forces. How, for instance, unemployment affects country's economy. The better a country's economy, the more it will attract foreign investment. Higher interest rates will make a currency more attractive. Fed chairman, retail sales data, etc. are some of the issues under fundamental analysis. Sentimental analysis. Each trader has his own opinion or explanation of the market. No matter how strongly you feel, you can't move the market in your favor. It is up to you to gauge how the market is feeling, whether bullish or bearish. In summary, therefore, the technical studies price movement on charts. Fundamental takes a look at how the country's economy is doing, and the sentiment determines whether it is bullish or bearish. Fundamental shape sentiment. Technical helps to visualize that sentiment and apply framework for our trades. That is all for the first two topics. In our next class, or in our second class, we're going to continue from types of a chart. Thank you very much. Remember, this is Atwegbe Ehizoge Lucky. You can always contact me for details via my number 080 375 97085.